This is the calculator we're going to use to explain CGT transactions. Of course, if you have a certificate from a trust or an investment fund showing the base costs, proceeds or selling price and the gain or loss, then you certainly don't need a fancy calculator, as all the amounts you need are on the certificate for you, ready to enter on the RTR 12. You can simply enter and itemize these amounts on these certificates right here and show base cost, proceeds, gain amount straight from the certificates. You can even itemize these amounts, and the itemizing grid allows or disallows community of property splits, etc. However, you will probably need help working out the gain amounts on other types of assets because it can get quite involved, and for that we need the CGT calculator lower down on the screen, where we can add as many different CGT transactions as we wish for a taxpayer. Different exclusions and exemptions apply to the disposal of different types of assets. So the nice thing about this calculator is that we can simply select the different types of assets by clicking on these buttons, and all the appropriate laws will be applied. You can see that we have selected this particular asset as an other asset, as it is a second property as opposed to a primary residence or a small business sale. Looking at this first very simple example, we can see that we bought this holiday house for 1 million and sold it for 6 million, so we made a profit of 5 million. The profit that SARS wants you to enter on the RTR 12 as code 4250 is the 5 million. SARS will apply any community of property splits, annual exclusions and inclusion rates. If we look at the screen behind this screen, SARS will apply all exemptions, exclusions, COP splits, etc. to this code 4250 amount. The calculator has done all this for us, subtracted the taxpayer's annual exclusion of 40,000 Rand, worked out 40% of the balance as being 1,984,000 that will be added to normal taxable income in the assessment calculation. Changes to SARS's definition of remuneration mean that this amount added to taxable income could now affect the formulas for calculating the deduction allowed for retirement fund contributions. Restoring the CGT calculator screen, we can see that the property was bought after capital gains tax came along in 2001. So working out what SARS calls the base cost and the profit is very simple. The base cost is the purchase price and the proceeds are the sale price. The proceeds, less the base cost, less certain other costs, is the profit or gain. You may claim acquisition costs such as registration costs, legal fees to prove ownership of the asset, etc. Improvements costs you may claim do not include maintenance expenses. If you fix the garage roof, then that is maintenance and you cannot claim it. If you built an additional garage, then that's an improvement and you can claim that. Now what if we bought this asset for 1 million before CGT was introduced on 1st of October 2001 and sold it for 3 million, giving us a profit of 2 million? Remember that only the portion of the profit which applies to the period after 1st of October 2001 is subject to capital gains tax. Fortunately, we had the asset valued at the time, and the value was 1.2 million on 1st of October 2001. This is our base cost, appraised value, and the profit will be 3 million less the 1.2 million base cost, which is 1.8 million profit. What if we did not have the property valued on 1st of October 2001? Well, then we have to use what SARS calls the time apportioned base cost or TAB method to work out a deemed value or base cost on 1st of October 2001. Using the formulas in paragraph 30 of the 8th schedule to work out the time apportioned base cost can be very difficult, but let's have a look at some simple examples we can work out manually. Yeah, I've gotten rid of the valuation amount and asked the calculator to work out a deemed value on 1st of October 2001. The calculator has used those formulas in the 8th schedule to work out a deemed value for the asset on 1st of October 2001. How did it do that? Well, it's actually a bit simpler than it may seem. You have to work out the total period of ownership of the asset and then proportion the profit over the whole period of ownership by the period before 1st of October 2001 and the period after that. You can count the number of years before the valuation date and after the valuation date, but remember that a part of a year, even one day, counts as a full year. From 8th of August 2000 to 1st of October 2001 is counted as 2 years. From 1st of October 2001 to 7th of July 2018 is counted as 17 years. 2 years before the valuation date plus 17 years after the valuation date makes 19 years. If we divide the 2 million rand profit by 19, we get 105,263 rand profit per year. Add the 105,263 for each year of ownership before 1st of October 2001 to the purchase price to get the base cost. This means we add 210,526 rand to the 1 million rand purchase price and we get a calculated or deemed value base cost on 1st of October 2001 of 1,210,526 rand. Subtract this calculated base cost from our selling price of 3 million and we get our gain of 1,789,474 rand.